Welcome to the Video CPA. I'm Michael Scott. I'm your host for this particular channel. And today we're going to be talking about adjustments to income. That used to be a big section near the bottom of the first page of the 1040. And now they've relegated it, the details at least, back to Schedule 1, Part 2 of Schedule 1. And so it's detailed there. But let's go ahead and talk about it. I'm not going to get into a lot of depth on some of these issues. And so if you need more depth or a video on any one of the issues by itself, just leave me a comment in the comments section. You'll see our disclaimer here. That's the affiliate marketing disclaimer, and then our educational disclaimer. Should be familiar with those. Okay, so this is the adjustment to income area. And you can see there we've got educator expenses all the way down through tuition and fees deductions. So quite a few items go in this area, and certainly not all of these items apply to every one of you. In fact, some of you won't have any of these items that apply, but some of you might have 2 or 3. So we're going to talk about each one in a little bit of detail. But like I say, I'm not going into great detail, or this video would be way too long. All right, let's look at educator expenses. This is a whopping $250 for teachers who are involved in teaching students kindergarten through the 12th grade, and who spend money on their classroom expenses. So if you're married and your spouse is a teacher also, you can actually take a $500 deduction. So this is done in the adjustments to income area, and not a huge deduction, but something that I guess the Treasury Department and the Congress decided would be nice to throw at teachers and give them a little bit of a benefit. So that's your educator expense. You're not going to get that unless you're involved in teaching, or a counselor, or a principal, or an aide at a school. Okay. Now let's talk about the certain business expenses. This used to be employee business expenses, Form 2106, before 2018. And before that time, almost any employee who incurred costs for their profession, for their business, could take employee business expenses. And what you saw most of the time is mileage on vehicles and maybe some meals and stuff. But anymore, they don't allow hardly any of it. So there's only 3 professions that are actually able to get a deduction for employee-related business expenses. And those are 1, performing artists, okay, and these artists have to receive wages of at least $200 from 2 or more employees, and the expenses have to be more than 10% of the total wages, and the AGI less than $16,000. So not too many people are going to qualify for this. Certainly, if you're looking at Tom Hanks or something, he's making more than $16,000. So this isn't going to mean anything to him or most of the actors that you know. So this is for starving artists, basically, starving performing artists. And then National Guard and reservists are going to be able to get this deduction as well. But you got to be 100 miles from your home. So these National Guard people that are in Washington, D.C., for example, and have been there for months, hopefully they're getting their meals and stuff paid for by the Guard, and they're not having to buy them themselves, because most of them probably aren't 100 miles from home, and so if that's the case, they won't get a deduction. And then fee-based government officials. And so if you're a fee-based government official and you've got qualifying business expenses, which would be mileage, it could be time away from home overnight, that type of thing, you can expense this on Form 2106, and that will go to your adjustments to income. So those are the first 2 adjustments. Now, there's a bunch more. Let's look at the health savings account deduction. If you've got a health savings account, you were actually allowed in 2020 a deduction for self-only coverage of $35.50 and family coverage of $7,100. If you got people over 55 years of age, you get an additional $1,000 contribution for them. But you've got to have in order to qualify for a health savings account deduction, you've got to have a high deductible insurance policy that qualifies. And so if you are contributing to a health savings account, though, this is where you would take the deduction in the adjustments to income area. All right, moving expenses. When I was young and in corporate America, I would incur moving expenses quite often, every couple of years, because I was moving around quite a bit. Now, hardly anybody gets moving expenses. You're really looking at members of the armed forces that can get moving expenses, and for most members of the armed forces, moving expenses are picked up by the armed forces themselves, but there are some moving expenses still available, but it's pretty much been wiped out for most people. So you're not going to see that deduction very often, and you're certainly probably not going to get it unless you're in the military. All right, let's talk about the next one then, the deductible part of self-employment taxes. Self-employment taxes are taxes that are incurred for people that have got their own business. And when I say that, it's got to be a non-incorporated type business. So it could be a partnership, or it could be a sole proprietorship, but those people are subject to self-employment tax. What that means is they do not get W-2s, and so there's no withholding on their income and no Social Security withholding. So self-employment taxes are basically Social Security for self-employed people. The only difference is that if you're self-employed, you pay the entire 15.3% of Social Security and Medicare taxes into the Social Security Administration, instead of just the 7.15% that employees pay. Now, if you're employed, your employer matches the other part of it. So, but if you're self-employed, that's not the case. You don't have an employer, or you are the employer, and so you've got to pay both parts of it. And so, as a result of that, the IRS kind of throws the self-employed people a bone, and it certainly doesn't make them equal to a employee, but it allows them to deduct 50% of their self-employment tax in the adjustments area as an adjustment to income. So if, for example, you incur $5,000 in self-employment tax, $2,500 is going to be allowed as a deduction in the adjustments to income area. The only people who are going to get this are self-employed people that have self-employment income. So good deduction for the self-employed. Like I say, it certainly doesn't equalize them with employees, but at least it's something. All right. Self-employed plans that these are retirement plans basically that cover self-employed people. So you've got SEP plans, SEP, you've got simple plans, simple IRA, and qualified plans. So these basically, like I say, are retirement plans for self-employed people, and the contributions differ for each type of plan that you've got there. Certainly if you have employees and you put money in for yourself as a self-employed individual, you're going to have to put in the same percentage of money for your employees if they're qualified. Now, in some plans, an employee can't join the plan until they've had a year of service or something like that. So there are requirements, but in most cases, you may very well have to contribute for your employee as well. need to be aware that these contributions do not impact self-employment taxes. They do not decrease your money that's subject to self-employment taxes. The deduction is taken in the adjustments to income area and not on Schedule C. So each of these plans, like I say, have different contribution rules and different contribution limits. So I haven't gotten into that here, and if you need more information on that, I can always prepare a video on those three types of plans. Actually, when you get to qualified plans, there's a lot more, but a lot more plans than just one. All right, let's look at self-employed health insurance then. Okay. Again, this is for self-employed individuals, and you're not going to be able to get it unless you're self-employed. So the medical premiums for a self-employed person for their spouse and their children can be deducted. Now this is the premiums, okay, in the adjustments to income or the other adjustments area of the tax return. Now that's only true as long as neither spouse is eligible to participate in a subsidized group health plan through an employer. If either spouse is eligible to participate in a subsidized group health plan through an employer, well, then the self-employed individual cannot write off his insurance premiums in this manner. The other thing is that you've got to have income from self-employment. It cannot exceed the level of income that you've got, and so if you've got $5,000 worth of income, you're limited to $5,000 worth of deduction for your self-employed health insurance. And the medical expenses include most medical expenses that you would have as an itemized deduction, really all of them: payments to doctors, dentists, eye doctors, medical insurance premiums, of course, and Medicare, long-term care insurance premiums, that type of thing. All right, let's move on. The penalty on early withdrawal of savings. Now, in most cases, unless you're a trillionaire or something, this is going to be very small. But you are allowed, if you pull money out of a CD early and you get penalized for it, you're allowed to write off that penalty. And those penalties are reported on 1099 INT or 1099 OID. Like I say, this usually isn't a lot of money unless you've got a lot of money invested in CDs or in other contracts. And then it might amount to quite a bit, but for most people, we're not talking about big bucks here. And this, of course, is when you pull it out early and end contract. All right, alimony. Alimony has changed a little bit in the last few years. Changed quite a bit, actually. So on the front page of, on Schedule 1 now, Part 2, alimony has 3 lines on it because it's what they've done is made it a little bit more difficult, certainly to deduct alimony, but also to figure out what you're supposed to do with it on the tax return. So in general, it's no longer deductible for divorces entered into after December 31st of 2018. And it's not reportable as income for those people who receive it for divorces entered into after December 31st of 2018. So all you've got now are the divorces that were entered into prior to 2019. And those divorces, if you're receiving alimony from those divorces, or you're paying alimony on a divorce that was prior to that date, those are still deductible. So alimony paid on divorces entered into prior to 2019, those payments are still deductible. So you'll notice in Section 1, you're going to have to put in a date of when the divorce was. and then the number of amount of payments that you had. So if that's the case, then you can still write off your alimony. You're also supposed to put in the Social Security number of the person that you're paying it to. If you don't have that Social Security number, you need to go ahead and try to get it. And if your spouse will not give it to you, you can report them to the IRS. The IRS will fine them $50 for not providing a Social Security number to you. So they are supposed to provide that Social Security number to you if you don't have it. So alimony, no longer deductible, but if you've got a divorce that happened a couple of years ago, you can still deduct it, and the other spouse still has to claim it. All right, IRA deductions. This has gotten a lot more complicated than what it used to, too. So let's just look at this for a minute. In order to deduct an IRA, a contribution to an IRA these days, first of all, it has to be a traditional IRA. It can't be a Roth or anything like that. It's got to be a traditional IRA. And you've got to be within the income limits, okay? And it does matter whether you're covered by a pension plan at work or not covered by one. So if you're covered by a pension plan, the income thresholds for your modified adjusted gross income are actually less than if you're not covered by a pension plan. So you can see here, single filers, the range is $65,000 to $75,000. It's got a phase-out range there. Married filers, $104,000 to $124,000. And these amounts are for 2020. And then if you're not covered by a plan, you can go all the way up to $196,000 to $206,000 for married filers. And I didn't put in single filers, but they can go up higher as well. If you're filing married and separate, if you've made more than $10,000, you're not going to get a deduction at all for this stuff. So for an IRA. So the contribution limit is $6,000. You can put in an additional $1,000 for those over 50, and you can have a spousal IRA. So if your spouse doesn't work, you can contribute another $6,000 for them, or $7,000 if they're over 50. But you've got to have enough income to cover that. So if you're putting in one for you and one for your spouse, and say you're both over 50, then you've got to have at least $14,000 worth of income before you can take those IRAs, take a deduction for those IRAs. All right, let's look at the last two items in the adjustment area. These both deal with education. The student loan interest deduction, first of all, reported on Form 1098E that you'll receive from the lender of the student loan. Now, the deduction is capped at $2,500. That's the most that you can get. Or you get the actual amount of the interest you paid during the year, whichever is less. Okay. So pretty easy deduction, but it is done here in the adjustments to income area, and you do get a report on it. So there's not a lot you have to do. You do get that report, but it is subject to phase-out rules again. So you need to check on the modified adjusted gross income, and look at the phase-out rules on that. Then the final thing in here is the tuition and fees deduction. And some people get a little confused here. I mean, you've got the American Opportunity Credit, and you've got the Lifetime Learning Credit. Well, these are credits, and that means they are deducted dollar for dollar from your taxes. A deduction is not deducted dollar for dollar. It's deducted, you have to apply the tax rate to the amount of the deduction. So if your tax rate is 30% of the deduction, well then you get basically a deduction for 30% and not for dollar, okay? So credit is much better than a deduction in most cases. But the tuition and fees deduction is still around. It's supposed to sunset here at the end of 2020, and whether it will be reviewed or not, I don't know. But still available for 2020. It's for qualified educational expenses up to $4,000, so you can have a deduction up to $4,000. And there are income limits on it again. Single is $60,000 to $80,000, married $130,000 to $160,000. So normally it's better to take one of the credits, but your tax software usually checks both alternatives if you've got pretty good tax software. So it will actually figure that for you, which would be best. But one thing you cannot do is take the tuition and fees deduction and then take one of the credits or both of the credits. And by taking the tuition and fees deduction, you're actually not allowed then to take either one of the credits. So you need to look at this fairly carefully. Like I say, it's usually best to take the credits, but and certainly in the American Opportunity Credit, it's going to be almost always best to take the credit. Lifetime Learning Credit, you can look at a little bit closer. If you've got questions on those two credits, I've got a video out there right now, YouTube video out there right now on educational credits and the difference between the two. So you might want to go out there and look at that if you've got any questions. All right, so those are the adjustments, and like I say, some of those adjustments a little bit more detailed. If you want me to do a little bit of work on some of those adjustments, let me know. Give me a comment that I can understand at least, and I'll go ahead and prepare a video on one of those. Thank you for watching. If you haven't subscribed yet, hit the subscribe button down there. If you need more about taxes, want to learn more about taxes, go to the video CPA's Targeted Tax Training. We've got a free course out there if you're interested in tax preparation, and you can go there and take that free course. So thank you for watching.